start streaming. Stream started. Radio voice check, 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 check. Audio good. Video appears to be okay. I see it pop up on YouTube. It is okay. Good morning. It's Friday. It's August 11th, 2023. Um, Been a very summery type of week. Haven't traded at all this week except for today. I did put on a trade today. Um, Very nice to take time off from trading and just reset the head and mentals and get back to getting things done around the house and using this summertime environment to do other stuff. We have a question right away here, and this is from Reversion, and he's asking, or she, I don't know, um, thoughts on strategy management as market regimes change, particularly as, oh my gosh, this cat, I didn't even know you were in this room. Hey, one of my cats is in this room and didn't even know. How did you get in here? Anyways, thoughts on strategy management as it pertains to market regime changes, especially as we see a strategy edge decay or disappear completely. Really good question. Hey, bud, you got to get off the keyboard. Sorry. Here. Um, Really, really good question, and I think we need to break it down into a couple different sections. This is something that I think affects discretionary traders as well as automated or mechanical traders. Edges typically, most edges that I've observed typically will experience some kind of decay in certain market regimes. And if we break the certain types of edges into their various categories, what do we really have? Typically, it's either trend following, edge, a reversion, or revert to the mean trend, or else some kind of other, I guess this is the other bucket, some kind of other strategy that does not take either trend or reversions into account, but rather maybe there's like examples of this would be like if you found an ARB situation that you can exploit, if you found some kind of pair situation that gives you time to be able to exploit the ARB on that. What else? If you found some inefficiency that is maybe part of the market structure or infrastructure that no one knows about and you can take advantage of it. You know, there's stories in the Market Wizards books as well as on a lot of podcasts about trading, thinking specifically about the Aaron Fifield one. What's the name of that one? What is the name of that podcast? He doesn't run it anymore. Chat with Traders. Chat with Traders podcast. So on there, he interviews a lot of traders, and some of those stories have situations of some foreign market where the exchange had some inefficiency where they could like get into a trade basically before anyone else could and then exit it before anyone else could, or something like that. A lot of those disappear, and those don't disappear because of regime changes. They disappear because the people running the exchange or the technology stack become aware of someone milking that inefficiency to its fullest, and then they patch up the code or whatever it is to take care of that inefficiency. So, yeah, Cat, you can't be on the keyboard. Sorry, bud. I know. So other than the other bucket, which typically isn't going to be relying on market regimes because those kinds of trades where you're exploiting inefficiencies in the infrastructure don't really depend on the market regime as much. It's more of that inefficiency that's within the technology stack itself. So really what we're talking about are market regimes affecting one of these two systems, and what do you do about it? So I guess I'll start with that I experience this regularly where my edge ebbs and flows. There are certain market regimes where my edge it's like, what's a good analogy? It's like you can't miss. You know when if you've ever played like street basketball or shot hoops as a kid, sometimes you just get in the zone and no matter where you shoot from, it seems to go in. Those there are market regimes where my edge, it seems like that. And then there are others, market regimes, when things switch around and it seems like the exact opposite. No matter where I shoot from, even if I am standing right next to the basket, I will not make a basket. It'll bomb out. Similarly, it's like if you're sitting next to a trash can and you try to throw something into an open trash can and nothing's blocking your way and you're right next to it and you toss it in and it just hits the rim or bounces out or you miss completely. Those happen as well. And it repeats in a cyclical fashion from what I've seen. It just comes and goes as the market regime shifts from one to the next. I don't think, I've thought about this a lot. I don't think market regimes ever repeat. I think they're always a little bit different, like thumbprints. I think that they um, have similarities between one another, but I don't think they're ever exactly the same. Like you're not going to see exactly the same situation that we saw in like spring of 2008. We're not going to see that exact situation again. I don't think we're going to see the exact situation that we saw in February and March of 2020, right after COVID came to the shores of the U.S. and the market reacted severely to it. There'll be things that are similar, but it won't be exactly the same. So how do you manage that? This gets into more like portfolio and risk management types of strategies. Also, it depends on if you're trading discretionarily or automated. So I guess let's start with the discretionary side. I am very keen on being observant of what types of market regimes affect my edge negatively, and I can list them out. Um, Market regimes that affect my edge negatively include, but are not limited to, low volume, low volatility, summer like uh, environments. So, entering these last 2, 3 weeks of August here, I am very happy to take time off because my edge depends on professionals who are doing significant large size, moving large orders. It depends on them being at work and doing their jobs because their clients are paying them to move orders on and off the books and move product. Without that, I don't have what my edge needs in order to participate. And I can see it through low volume, low volatility, calendar days, etc. And so as we approach the end of August here, a lot of those professionals are at their summer houses enjoying the last vacation with their families or the last few weeks of summer before getting back into things once school starts in the fall. The kids go back to school. Everyone kind of settles in here in September, and things start to pick up again. But I know this. This has been constant for years. That things get really wonky in the summertime. So what do I do? Well, if you've watched any of my live trading, you'll see that I react to this by doing a couple things. One, I take more days off, like liberally take more days off. Like I took every single day this week off except for today. I was just watching the market and doing work. I didn't even trade. And that's okay. I'm getting rest, I'm getting recharged, and I'm not participating in these um, in this market regime, which is really affecting my edge. I don't want to be sitting at the next to the basketball hoop, throwing shots and having it rim out every time. Like there's no point in me to participate during that. I'd rather sit on the bench and get other stuff done rather than participate in that. So I take more days off. Number two, I lower my size. Well, I should say I lower my risk, which in a result is lowering my size. And why do I do this? Well, it's not the market environment where no matter where I shoot from, again, to use the basketball analogy, it's not the market environment where no matter where I shoot from, even if I'm doing a fadeaway spin jump, 3-point jumper, that those will always go in. So why would I keep the same amount of risk and keep the same amount of size on to trade a less um, probable market regime? I wouldn't. I would either take the days off entirely or lower my risk. So all of summer I've been taking more days off. I've lowered my size, I lowered my risk amount, and so my losses are smaller, my wins are smaller, and I'm trading a lot less frequently. Um, when the market regime will change, and actually I was just talking to another trader, equities trader, yesterday about the latest regime that we're in. Um, Within the last couple of days. I think this week, really, there might have been a market regime change as well. When the regime changes to something that's more favorable for me, then I need to identify that, acknowledge that, be aware of those changes, and then very quickly adjust my discretionary trading to accommodate for those changes. So once I see the professionals start coming back in, they're going to be leaving their summer homes, coming back to work, and start moving orders. What are we going to see? Well, for my edge specifically, I'm going to see things like higher pre-market volume levels. I'm going to see higher volatility and more volume in the large and mega cap names on the equity side. I'm going to see orders get run for longer periods of time. One of the things about summer is that these order sizes are in general, not always, but in general, smaller than orders being run by large funds that are buying, I don't know, millions of shares or selling millions of shares of a specific product. Um, and what I'll start to see is the runs will start to get longer and more follow through. So my system is really a trend following system, and those trends will continue with an easier time. What I'll also see is that my win rate will pick up. So win rate will start to pick up significantly during the summer. I don't know what it is just for the summer, but during the summer my win rate definitely takes a hit. I don't trade that frequently. Like if you compare my trading versus Fat Cat, for example, he puts on what, sometimes 5, 10, 15, 20 different trades a day. I typically don't put more than 2 trades on a day. If I get to 3 trades a day, that's a high frequency of a day for me. But what I'll see is that my win rate, it'll be that situation where I'm shooting buckets and everything's just going in. And so I'll start having like 100% win rate days over and over and over. Um, that's another sign to me that I've seen that market regime change is happening, and then it's time to consider: are we out of this summer doldrum? Is it time to start raising my risk, raising my size, and start getting more aggressive? Um, so that's kind of the side. That's my take on it from the discretionary side. So all of this is for the discretionary side. If we look on the automated side,
Order rejected.
automated strat and risk management. Did we just have news hit? All of a sudden, I'm seeing all the large caps tank. Was there some kind of news that just hit? I don't see anything. Okay. Um, all right. So from the automated side, this is a bucket of this is a bucket or a can of worms. What's the problem with making changes? So there's a problem, in my opinion, there's a problem with making manual changes to an automated system, automated system, based on subjective human emotion about risk management and market regimes. Because there's really no way for you to, uh, there's really no way for you to, what's the word? Average this out and make it consistent from every single time. As you start to introduce subjective human choices into an automated system, you are introducing these variables that you will not be able to reproduce. I have done this. I have made manual changes to automated systems. Almost every single time I do, it comes back to bite me in the you know what. And my approach to this in general now, barring anything extreme like I don't know, pandemic breaking out or like a world war breaking out or some kind of huge geopolitical event, aside from something like that, if we're just talking about market regimes and not some kind of world-altering event. Um, because if there is a world-altering event, I think it does make sense to make a manual change. You can turn a system off just to pull everything if something crazy happens. That does make sense. I'm talking about nothing like that has happened, and we're just seeing a. I was short this thing in the morning. Um, we're talking about something that is just market regimes changing, like from summertime to non-summertime. I see problems with making manual changes to these automated systems based off of that. I am in the camp of your automated system should be it should either consistently continue to trade your system in an automated fashion in any market regime, or you need to develop an automated module for your system to address the changing market conditions or whatever is happening that is causing you a performance hit. So maybe what does that look like? There's a couple of ideas. One from the risk management side, and from also the portfolio side. There's a couple of ideas. One, maybe you start tracking how many, like the number of wins and losses you typically gain throughout one day. And then maybe during that market regime change, this changes drastically. Like it's severely out of line of what you typically see when the market regime is in your favor. So maybe you develop a module that detects an out of bounds number of wins or losses, and it automatically takes action on that, reducing your size or stopping trading entirely. That's not you as a human coming in and saying, "Hey, I'm losing a lot today. Maybe I should change my size." That's the system. If you code it and it's automatically doing all that without your intervention, that's a form of risk management. You're saying that, I typically don't lose this much or I typically don't win this much, and I need to modify the risk amount going forward. Personally, I have played with a couple of these ones. One of the ones that has worked quite well for me actually and I know it's kind of against common like preaching. If I get up very big P&L wise in my automated system very early, and I have those defined, what early means and what big means. It's a multiple of my daily drawdown and times of day that are important to me. If I get up very big in P&L very early, I will actually shut it off for the day in an automated fashion. It will turn itself off. And I do that because what I have noticed is that on those days where I typically where I do get up very early and very high amount, like multiples of my daily drawdown, I end up bleeding it back on subsequent attempts through the automated system. It's just I don't know why. I can't explain why to you. It continues to try to take trades, and it typically loses in those situations, which is really odd. So I'm better off after examining the whole thing that if I get up a lot and early, I will tell the system to turn off, and we'll just take that and run with it till the next day. Um, I've played with other versions of this. I think it really depends on what kind of edge you're exploiting and what frequency your system is trading. Like if you're only making one trade a month, this may not be the way you want to go about it. You can do similar risk and portfolio management types of things based on if you're trading more than one instrument. Maybe if you take consecutive losses on consecutive trades in different instruments, maybe it's just not the day or the market regime for you to push, and you can detect that as well. I guess the overall 2 cents on it is if you're making an automated system, make your risk management automated as well. Don't or I mean do what you want to, but I have not found success on using human emotion to regulate risk management on an automated strategy. That's how I'll put it. I have not found success using human emotion and subjective bias decisions by me during in the moment to make good decisions in hindsight on automated strategies, which is why I code them ahead of time. You test them, you forward test them. I'm not a huge fan of back testing. That's a completely separate topic, but I like to forward test everything with live money and live executions. That is my preferred way to know if something works. Um, but again, that's a long side topic. So that's how that's how I would approach it. So going back to the original question that Reversion asked up here, how do you manage strategies as market regimes change? I've built market regime calculators before. I do use certain versions of them. One of the tools I think I released in a video from a while back, it counted like the number of highs and lows that a stock had made above its pre-market highs or below its pre-market lows. That tool I still use every day in both my discretionary and actually in my automated trading as well. So that's one of the tools. Like what I've noticed, for example, if I see a day where the ES is only doing, um, I don't know, like one high above its pre-market high and one low below its pre-market low, I know it's not a wide range day. I know it's a more contracted type of, day. It's not a trend day if we're only at 1 and 1. Now, if we're at 10 and 0 and it's only, let's say 9:50 or 10 in the morning, I know that we are trending up, and I can use that again in an automated fashion to dictate decisions further on in the day. I also use it not just on a market-wide, but on an individual equity basis as well, this same tool. Another tool that I use heavily is the true range, in other words, the high minus the low, the true range of the day for the the overall market, for the ES, in fact. So I look at a combination of what the ES has been doing in terms of range over the last whatever bar periods or number of days, weeks, and then what we're doing today so far intraday. And based on that, I'm actually adjusting. So um, here's another thing for you, Reversion. Let me draw this out. How do I want to draw this out? My risk and my targets in my automated strategies are all dynamic. If you were to ask me if you were to ask me yesterday what today's risk and targets would be, I would say I don't know because it's all calculated at live time through dynamic algorithms that I've built. And those dynamic algorithms from my side are built on a combination of different inputs, including but not limited to those two that I just said, the true range of the ES and the number of highs and lows above pre-market levels. And it's important for me because of the trend following nature of my edge and my system. So that's why I watch those two things among others. But additionally, if, for example, let's say the ES is only doing 25% of its typical range and it's 10 a.m. and it only today has done 25% of its typical range. Should I be looking for home runs on my targets and risking a huge amount on my trend following system? What do you guys think? If the ES is only doing 25%, do you think I will find a lot of success risking a large amount and then looking for very, very large targets? Or has everybody fallen asleep? Oh my God, I made everyone fall asleep. I could sell one of those like white noise audio CDs or something. Just lull people to sleep. That's how my wife gets to sleep. She's like, "Tell me about the stock market." And I'm like, "Well, today it went up and right away. Then it went down and then it went up." Yeah, obviously no. No, if the ES is doing 25% of its range so far for the day and it's 10 a.m. and it's only done 25% of its typical range, yeah, I'm not going to be shooting for the moon. My system detects that and says, do what I call hyperscalps. Engage only in hyperscalps. So it changes for the day type for me the risk that I'm willing to take and the targets. Again, the day before, I have no idea what my risk or targets are going to be on the following day because I don't manually, subjectively set them. They are being calculated by what the market is doing that day. And I found a lot more success with that. So when the ES is doing these very, very, very tight little days, if I take any trades at all, they're going to be tiny risk with very, very small risk reward. I still always get more than 1.x to 1 risk reward. I won't ever go below a certain threshold. I just won't take the trade then if the risk is greater than the reward amount. So it's like a little safety check built in, but I will take profit earlier and I won't risk as much if it's these types of days, and it definitely affects the frequency of trading. Now, what if we don't have this, but we have a day where by 9:30 a.m. we're already doing 95% of the range? What does that mean? Well, that means I'm going to start off scalping, but let things run if they work. And it's a different mode I have in my system that will basically say, hey, we're already doing 95% of the range in the ES and it's not even 10 a.m. If we get a position on, take a moderate amount of risk and get some off to cover the risk, like not hyper scalp wise, but reasonably. And then let things run because these 95 percenters by 11 a.m. can turn into something like this, 136%. And then those runners that I left on those positions, they do a lot of work. They do a lot of work. And so those won't actually run on my system unless my dynamic target, module and risk module detects those conditions. So I guess reversion, this is a really, really long and arduous explanation of it really depends on what your edge is, how you're approaching it, your time frequency, your execution methods, your so many different things. There's no right answer here. There's a bunch of wrong ones, but here are a couple of different ways that I use to mitigate the regime change risk, even on from a day-to-day level where we're still within one regime, but day to day, you can have a big up day or a big trend day, and then the next day is real tight and nothing's going on. So I let my system in an automated way react to what's happening rather than putting in my typically wrong human subjective decisions into that. So I'll let you ask a follow-up because I think I've been talking nonstop for about 36 minutes. And then I see we have a couple other questions. While you write your response, I'm going to go grab these other questions. So Reversion is typing a response to that. Does anyone else have questions about what I just talked about? This is a really tricky thing, and I'll be transparent. Learning this cost a lot of blood, sweat, and tears. Like it's almost like you have to just fail at it constantly until you finally are like, okay, what do I need to do to make this work? Which feels like trading just in general. Um, just in general is like a hit your head against the door, touch the hot stove enough times until you learn better. Reversion responded, that makes sense. It's painful, a lot of work. Oh yeah, yeah. There's absolutely, exactly. There's no easy way to just mitigate risk like that. You have to constantly, I mean, you don't have to, you can do whatever you want, but I am constantly thinking about risk and how to it's similar with the automated side, just as it is with the discretionary side, in the sense that it's not so much the winners that you have to worry about, it's the losers that you have to prevent the stupid losses, like the losses that just make no sense. Like you shouldn't have been in there, you shouldn't have done that size, you shouldn't have. And one of the things I saw, where was it? Oh, like I'd have days like this happen, and then I'd be trying to take a large amount of risk and like go for like 3-to-1 targets on these days, and then it'd come back to stop me out because it's a choppy, tight contracted day. And it's like, why did I take a loss on that? I was up 1.5 to 1 on it, and we're only doing 25%. Why didn't I just take that profit and move on to the next trade? We're clearly not trending today. And so it's those kinds of painful, like you have to have that hammer hit you on the head over and over. Or maybe if you're smarter than me, you don't need to have it hit over and over. I'm a slow learner. But that's what it took for me. I just had to keep seeing those stupid losses come in for things like that, like trying to squeeze blood out of a rock, in the sense that, ES is only doing 25% range, and I'm expecting a 3 out of 1, 4 out of 1, 6 out of 1 um, return. That being said, I also don't want to do, on the other side, I don't want to cut things off when they are working, and this is a trend following system. I have seen in these situations things run to 10-to-1, 15-to-1 against my risk, but I cut them off early because I was like, oh, I hit my 2-to-1, I should, or my 3-to-1, I should take the whole position off so I don't give it back. When it's these situations, I leave a runner on. Why? Because over time, it is painful to see it continue on for a 10-to-1 winner, and you cut it off, or I cut it off at 2-to-1 or 3-to-1. That's painful. And you do that enough times, and you learn to do something differently. So now I do leave a piece on, and I let it just run. I let it run. And then when you get something like this happen after it was 95%, you get to 130%, maybe even 175%, and then you're looking at like a 15-to-1 winner on your runner. Very good feeling. Especially after being banged on the head so many times, being wrong. So yeah, it's anything but easy, and nothing I say will do it for you. This is just like a framework to think about it. It really depends on what your edge is, what your system's doing, what your risk profile is, because not everybody can let this happen. You may not have the emotional constitution to allow yourself to let things run like this. Um, Other people may not have the, you know, whatever personality to to do these types of hyper scalp trades. Maybe it's not worth it for them. So it really depends on what you're trying to do, what you're running, what you're trying to accomplish. Um, yeah. Okay. Let's move on. Morphus, hello, good morning. Is it possible to bridge Sierra chart data feed to other platforms like Bookmap through a study in Java code? Let me make sure I'm understanding. So you got the Sierra chart feed, and then you got Bookmap, and Bookmap runs off of some stupid expensive feed. Ask me how I know. Um, the answer is I was a Bookmap customer before I found Sierra Chart, and it was really stupid expensive and really, really beautiful, but only a fraction of the functionality that you can do in Sierra Chart. So, um, sorry, Bookmap guys, your platform is not there yet compared to Sierra. So I switched, but very pretty. Bookmap has very pretty graphics. So if graphics are important to you, this is a fun visual. So you want to take the feed from here and feed it into here. So I guess there's a couple of questions. One, I'm not familiar with the Bookmap API enough to know if you can use another feed that you manually provide as the input feed to Bookmap. I don't know how they lock that down. So I don't know if Bookmap requires you to use their feeds. Like, I don't know if they expose the ability for you to use other feeds as an input and what that feed would need to look like and how it would need to be served. Sure, you can create API code via any language, but can you actually feed a different data feed to Bookmap? That's the question. I don't know. Morphus. Like, yeah, I know there's a Bookmap API, and you can write your own like studies or something for Bookmap. I haven't looked at it recently, but years ago I looked at it. I'm not sure if you can actually use another feed though to provide um, the data that actually renders this on the chart. Um, in Java code, now Bookmap's written in Java, I believe. Another point against Bookmap. Um, Kat, do you need to go? You probably need to go out of this room. That's why you're bothering me. 1 second, guys. So what was I saying? Yeah, it's written in Java, I believe, and you can write Java-based studies for it. But I don't know. I guess we can look on the Bookmap API. I don't know. Bookmap API knowledge base. Let's look. What do you wish to develop? Analytics, trading strategies, indicators. Nope. Add-ons. Nope. Quant solution. You want to develop a feed. And there's what about others? I don't understand what's happening. I want to develop another feed. I can't click on any of these. Okay, that's weird. This is feedback. I'm just looking for the word feed to see if I can. Order by order full depth adapter. API add-ons, also called the Connect API. API add-on, create custom market data and trading connections. Develop adapters that can connect Bookmap to additional market data or trading services. So you can do that, Morphus, based on what they're saying here. It says yes, it is called an L0 or Connect API. Oh, here's an example. What is this written in? It's written in Java. Here you go. Yes, you can, and here is the link for that. So it looks like you can develop. So then what? Would you would need to do? Let's get this out of the way. So knowing that we can use that layer 0 API. Let's call that layer 0 API, which is basically a data feed. You can build some kind of module in Java that would read the data that you would export from Sierra Chart's feed. Now, how do you do that piece? Well, you have a couple options. One, I suppose you could have an option where this module reads um, the intraday files that are written to disk here. That's one option. That's probably slow, but let's write it down. Let's write down these options. Read Sierra chart intraday file. Slow, I'm guessing. Two, you could have this have some kind of socket connection to one another. So you could have some kind of WebSocket. Actually, I think that term is reserved for a different meaning, so I won't confuse people. But you could have a socket connection, which the Sierra chart study would then create a socket to your bookmap, whatever this is called, this layer 0 implementation that you build, and then feeds the data straight to this, and then you can push it into there. So a socket connection, this would be fast, but stability would be, you would need to really beef it up. So stability would potentially be a concern. I guess stability could be a potential concern with any of these of how you implement them, but regardless, the socket connection would be significantly quicker than the intraday file. One other concern there is that with a socket connection, what does that do to the main thread on Sierra Chart's feed? Or on the Sierra Chart application, I should say, the main thread, if it's trying to serve data back to a socket and it's hanging for reads, that could cause some instability unless you like fork it off to a new thread or a different process or something. Then maybe you could do that through here. What other options do you have? There is, what is the name of that feed? I haven't written to it yet. I should start getting into that. What is the name of it? It's the DTC protocol. The DTC protocol feed is another way. You could have this implementation on this side go and connect to the DTC protocol feed and read that data from here and then push it into Bookmap. So I think those are the top three ways. I would ask a follow-up question to you, Morphus, of why. Why would you want to do this? Why would you want to do this? And then I'll go back and grab some other questions. We also have, I think Ahmed asked this one. I'll put this one next because he had this one here.
Hi, Reversion, you right?
Hey, Morphus.
Hey.
Hey.
Basically, Bookmap accepts data from Rhythmic, and I have already connected with Ciara with his denial data feed. So I don't want to keep finding paperwork and more cost to the you see what I mean? I have the same connection. I just need to bridge these two together. And I think it's possible, but I'm not sure if it's possible from Ciara. Ciara denying that Bookmap to take data from Ciara. So it's
Well, yeah,
saying
they
no.
wouldn't. They would not want to have you be feeding a different platform with their data. Yeah,
It's not
I'm
a
not surprised that.
platform. It's a denial data feed. It does not accept Bookmap platform.
Oh, yeah, it's not built for that. Sure, that makes sense. Yeah, why would they?
Yeah, well, I'm not sure what the cause of the issue is, but I think it's to do is they don't want to give out data so people stay with Sierra chart. I think
Yeah.
it's Sierra chart saying is not denial data feed.
Um, I guess that answers Wayne's question about what does the Sierra feed have that Bookmap doesn't, and it also answers the why of you'd want to do this. Why not just Oh, because Sierra and Rhythmic have that contentious relationship. That's probably why, right? They don't like each other. Why not just switch to? I feel like there's other more graceful solutions to this issue, though. Like I
But
know that Bookmap integrates directly with Rhythmic, but are you stuck on Rhythmic? You can't use anything else. Your broker only accepts Rhythmic.
now Rhythmic is requiring me to sign up and sign documents and stuff. I'm already in the market as non-professional. So I don't want to sign two documents conflicting with each other. You see what I mean? I have
Yeah.
denial and I have Rhythmic, which is, I'm sure it's going to backfire on me somehow. So since I have a data already I'm paying for, I want to forward this data to Bookmap because Bookmap have a very good feature. The stop hunt and all stuff is really cool stuff, and Sierra doesn't have it. But the
What is
data,
it? Wait, say that piece again. What do they have that Sierra doesn't?
stop hunt, like if let me explain them mathematically how I understand it. So basically, we see only buyer, yeah. When we see the market going down, it will hit these buyers. When it hit these buyers and the seller on the other side, which we don't see, so Bookmap basically calculate how much it was in pending order and how much been already come out of this hidden area, which is the other side of the trade. And they calculate it and they give me like how much been hit, how many stop loss been hit. It's calculating the orders, MBOs. It does all this kind of things. It's very cool stuff and give you heads up of market continuation or reversal. I did test
Um,
it. I did test it and it does work. I have Bookmap, but the feed is the issue to me right now.
I don't want to sound mean. That's not my intent with this, but I feel like a lot of those features that you just described are fancy words for things that you have available to you in Sierra that you could implement within Sierra. Um, but more importantly, don't actually result in. I think I guess there's two things. One, the claims that they're making based on what you just said are pretty ambitious, I should say. The no one has access to other people's stop orders. Like Bookmap or the feed they have cannot see someone's stop orders. So that claim of you can see the stop orders, well, no, you can't. You can't see the stop orders.
Can I
Stop
just,
orders are, yeah,
sorry, can I just mention one thing? Okay.
yeah.
Basically, the book, of course, no one have this information until the information become available in the market. So how I can know that? Basically, if we have buy orders, just the next level, say 100 lot, for example, and the seller is maybe 50 or 100 as well. Then when the market push down, out of this 100, we have 150. So if you that 100 minus 100 will give you 50, will become out of the other side, which we can't see. If that makes sense.
Yes, that makes sense
It's
for the folks
calculation.
following
Basically,
along
they're
at
doing it. Yeah.
home. Basically, if on the ladder you're seeing we're at a level and you're seeing that the bid right beneath this level is advertising, this is the advertised 100 lots, but then on the tape we see 100 and then 50 lots go off at that price, at this price. We see that go off. That's essentially what you're saying, and then you're saying, well, that 50 was a stop loss. That's a completely implicitly derived conclusion. Um,
Where the
you
50 come from?
you do not know if that was a stop loss. Let's go back to the definition of what a stop loss is. A stop loss is either a client side or server side triggered mechanism order type. I misspelled mechanism. mechanism, order type, that will submit a simple market order once the trigger price has been tripped. In other words, executed at. That's all that is. That 50, you do not know if it was someone's stop order, and then, like, if their stop order was at the tick above, or at that tick, and then the 100 hit, and then their stop order sent a market order in for 50 lots. It could be that, potentially, but it also could be an algo that saw the 100 hit and was like, I'm going to immediately put in a bid for 50 more, and this seller continues to hit the bid. And so this, while the execution happened on the bid, it could have been an algo joining the bid for that amount because of something else, potentially from the 100 lot being hit at that same spot. You don't know you don't know if that's a market order. This might be an aggressive buyer, not someone stopping out of a long. This might be someone trying to get into a long, joining the bid based off of something else they saw. So
Sorry
it's
for the.
really,
Can
yeah.
can can I just shed some light on what I'm saying? Is the 50 was a still order. So I'm talking about the 150. So 100 on the right hand side of the DOM, and when the market moved to one tick down, we had extra 50 come out of the blue, like come out of the hidden area. And with this feature, when you calculate that level against what been triggered and what was been present before, you can tell how much been sold here. If I'm a buyer, I will be putting still order in the market, but hidden. No one can see it until it come and hit me. Vice versa as well. If I'm a seller, I will be a buyer to exit the market. So that's the feature I'm talking about. I'm not talking about the 50 on the buy side. I'm talking about the 50 on the sell side.
No, I'm confused. You're saying that, so if this is the tape of the executions that happened, this is the tape ticking down. There's another order down here of whatever size, right?
Mm.
This is the tape, and this is the
100 here.
offers. Here are the offers, right?
Yeah.
So someone came and hit this advertised 100, and there it is. But then also a 50 showed up after that,
Yeah.
right? That's what you're saying, right?
Yeah. Which is at the level of the 100.
Right.
That makes sense. So originally there was 100 only available there, but whoever sold 150, but it was 100 up there. So the 50 different. Would that come from?
How
That
do
come
you
from the
how do
column
you how
down.
do you know how do you know that the person who sold this 100 is the same person who sold this 100 or this 50? How do you know that?
We don't know that until the market reverts from this area, which it does in different occasions. So the bookmap, how it works is you filter how much you put filter on, like what the limit is, the maximum and minimum. And when you see this been triggered, the market literally reverts back up again. So take the top and bounce up, or take the highs and bounce down. So that feature, it is available in Sierra in a different way, which you have to monitor and you have to calculate quickly by your eyes. You can make a study out of it. But Bookmap actually calculate everything for you and just to put a bubble below, say that it was like 250 still order been triggered down there, and the
This
market
is
bounced.
this is snake oil, Morphus. This is snake oil. There is absolutely no way. So the raw feed does not contain information from which they could derive such concrete assertions. There is no way for them to derive that any other way other than implicitly suggesting that that is what happened. The fact that the market reverses here has absolutely nothing to do with the origin of who initiated these two. Bookmap can no better than you flipping a coin decide if these came from the same person or not, regardless of what happens before, during, or after this execution. Um, they are just trying to piece together using an algorithm that they're using, looking at the very basic data, I mean the very basic structure of the feed data that comes across, and everyone gets it, the same stuff. You can even, if you subscribe to a raw data feed, you could get the same exact stuff too. And look, we have a timestamp, timestamp. We have a price of execution. We have the quantity that was executed. We have the best bid, the best offer, and there are, sure, some other fields that are carried in, but just to keep the sake of this example simple, I'm going to omit them. This is the basic stuff that you have coming through. So the fact that this 100 happened on the best bid at that time of execution, the best bid was the price that this 100 got executed at. That is what makes it look like it was a seller hitting the bid, because the price executed at what the best bid was at that time. The next 50 that came off was also on the best bid. That does not necessarily mean that that 50 was a hidden stop loss order. That's what Bookmap is algo is trying to suggest to you, but I bet there's somewhere in the fine print that says this is not actually what is happening. It's just our best idea, and we built this algorithm to try to suggest that. And sure, it's a legitimate suggestion, but to take it as gospel and that's exactly what happened there, you do not know, nor do they, if that was a stop order. This, at the same time, could have been a completely random other market participant joining the bid who just happened to join the bid at the same exact time. And there's no way you can tell the difference between the two. There's like no way you can tell the difference between the two. So you have no way to actually discern if it was a stop order or just a completely separate random market participant joining the bid at that exact moment for that size. So yeah, like I think one of the things that you could potentially look at, and I don't know how this works on the CME feeds, but there are these bundled and unbundled trade indicator settings that come across on the feed. They might offer a look into what, if there was a parent order for like 150 lots to sell, that might offer, then you might know that the seller is the same, but that doesn't mean that the buyer is different or that the buyer is the same either. I don't know enough about the unbundled and bundled trade indicators to like comment on that. I have to go research that, but there is no there's no confidence that this is a stop loss order that just happened to hit the book because that one because the price moved down and hit that 100, and then a seller hit that 100. There is zero proof, conclusive proof that that is the case. It could have just been another market participant joining the bid after that 100 happened. Does that make sense? Like, and anyone telling you otherwise is selling you snake oil. Like, there's no magic indicator, no magic anything. Like, you do not know where other people's stops are, and neither do they.
Yeah, I understand, President. I understand your view, but what I'm telling you is the way I understand it is when I look at footprint, for example, that when the seller hit, I mean, the seller is unbalanced, yeah, then if the market doesn't go that direction, it bounces off. And that's the same thing, but this is like is calculating it for you and give you the number you're looking for instead of looking footprint, because that's the concept of trading. If I see that they keep selling heavily, but the market doesn't not want to move, then it bounces off. Then that's where absorption happens. You see what I mean? It's connected to the
Yeah,
same concept, but I just want to mention as well the 50 it was hidden orders. They just appeared and they're not matching with the pending orders, which is 100, which is offer. That makes sense. So
hmm
with the right algorithm, you can calculate, you can do it with your eyes. Like you see there's a lot of selling, but there is no progress. There is no moving down further. Then the market just bounced one tick or two above this line. It suggests that it actually was a lot of selling happening at this level, but it was not enough to keep the market going that direction. Then the market have to turn back up and look for liquidity somewhere else, if that makes sense.
hmm Yeah, yeah, of course. We see that regardless of instrument type, security type, even in equities side, you'll have something trending down into a major level, and then some hero shows up and is like, I'm going to hold the bid right there. And they're hitting them, hitting them, hitting them, and the bid's advertising maybe 100 shares, and maybe, I don't know, 200,000 shares goes off right at that level, and then it bounces. So the absorption piece is contextual, like you said, but yeah, I think you could recreate this in Sierra, but if it's easier for you in Bookmap, then I mean, one other option that is here is just to pay them money for their expensive feed and then just use that feature if it's that important to you. That's another option, a fourth option. But in terms of bridging and sending the Sierra feed over, I I don't even know. That might not even be allowed according to their terms of use, but the ways that I would look at doing it are probably the last two of these three. I would look into the DTC protocol, and I'd probably look into DTC first and then the socket connection. That's how I'd go about it. So
Yeah, I'm
maybe the
gonna give it a
DTC
go.
protocol, you can feed it over to here without the overhead of running the Sierra Chart desktop application. So this is probably the best way to go to accomplish what you're trying to get done.
Yeah, I will give it a go. I'm trying Bookmap at the moment. I'm not buying it, but I'm just testing it out, see how that
Someone
benefit
someone
me.
above said something about a free trial. You should go back up and
Yeah, I did. I'm doing using the free trial now. I'm
or
using data
belligerent.
feed
Yeah.
from another broker, which is not the full book. It does not give me the ability to have the full bundle. But I have a full bundle already on denial, but they are refused. So because they say no, it doesn't mean no. It's not possible. That's the reason I'm trying to bridge these two together.
Mhm. Mhm. Okay, let's move on to the next one.
Thanks,
I'm
mate.
just gonna post a couple of these. Yeah, yeah. Post a couple of these related comments to these. Let me grab. Let me grab these and move them down. Okay, Ahmed, I think this one was yours. Yes. Okay, so Ahmed's asking, in a time-based chart, I need this space to be empty. Let's take a look. There's just no trade data in between there. So I guess the question, Ahmed, is this area off hours? So it doesn't look like it is. It looks like it's not off hours. Um, it looks like it's during market hours, so it's not like an overnight session or anything, right? Or is this time, this 15-minute period, is this always empty? Is this like a weird, I don't even know, what is this, Bitcoin? Binance? What is this? BNTCNQ. I don't even know what the feed that is. In Sierra chart, it fills the space. Is this not Sierra chart?
It seemed like it's missing data.
This is during a halt, yes. So is it a trading halt for the instrument? Is this like an equity that just popped beyond the circuit breaker amount? So it was a circuit breaker halt, and then it halted again, and then it halted again. Why, can I ask why you would want to remove halt times from a chart? Sometimes it doesn't appear in Sierra chart. I'm not sure what you mean. What doesn't appear in Sierra chart? The halt? I'm not sure if there's a way on a time-based chart to, because I don't know if there. Oh, Sierra doesn't tell you that the symbol was halted, is what you're saying. Sierra doesn't explicitly put an capital H somewhere on the chart so that you know that was a halt period, is what you're saying. Um, the platform doesn't do that. I gotcha. Okay. I think that's what you meant by that. Um, what are you accomplishing by removing that though? Especially on a time series chart, I question the what do you get out of removing this? Like, how does that help you in any way? One thing that you could do is either build your own or look for your own. If this is equities, is reverse engineer the circuit breaker rules. I think a stock has to move up. It depends on the price of the stock as well. There's like specific rules. Also, it depends on what exchange it's listed on. Excuse me. It depends on what exchange it's listed on. There's different rules for different price stocks on different exchanges and equities for their circuit breakers. Like certain stocks listed on NASDAQ will get halted for a 5-minute period if the stock price is below $10 and the stock moves 15% in a 5-minute period or something like that. So you could reverse engineer that and build an indicator to detect halts in Sierra and then write a halt notification there. Or what I typically do, I mean, my platform shows an H, Lightspeed shows an H when a symbol gets halted, but what you could do is just go look up that symbol and see if they're halted, like have a halt list. That's probably publicly available. Also, if you're a member of like StockTwits or any of those other um, communities, typically people are tweeting the crap out of halted stuff, so you know right away. I mean, you say that you don't know the stock was halted in Sierra, but let's take a look. We don't explicitly know, but we see a move from $2.20 up to $3. So it's a 33%-ish move in, what is this bar period? I don't know, I can't tell if this is 1 minute, 2 minutes, or something. A 33% move in less than 5 minutes. And then a very long halt, maybe even a news halt. Maybe this was the company that released requesting a halt. Um, yeah, and then and then it halted again up here. So this one may not have been a volatility halt. This may have been a news halt. This one may have been a volatility halt. But in terms of programmatically, I don't even know if Sierra offers that. Sierra chart halted trading. Let's search Google. Data halts. That is not. Someone asked for this. Limit up, limit down halts. Um, check out this thread. Check out this thread. I posted it up in the. It's called halt limits on a feature request for the support board. Someone attached a chart book of how they deal with that. Um, looks like it's a longer thread, so check that out. Does anybody know of a Sierra chart ATOS bridge? I do not, Steph. um, okay, Luca. When you're trying to automate stops, is there any advice you have on what you generally have the code look for? Is it a completely strategy dependent thing? If so, what's your personal preference when you made your most recent strategy? I know you avoid magic numbers. I try to. Um, Extra points to Luca for saying avoid magic numbers. I'm trying to get inspiration on all things related to this. So, um, this thing on stops is really a conversation, Luca, on personal risk appetite. Some traders like to run positions with no stops. I am not one of those traders. Some people like to have mental stops. I am not one of those traders. Some people like to have physical stops. I am one of these traders. Both on my discretionary trading, where I always enter a stop. Even before I get filled on the position, I have a stop in place. And also on my automated trading. And there's a reason why, and it comes down to this piece, my personal risk appetite. I do not like the black swan potential of my entire trading system go down. I get filled on a position, and then I cannot get out, and it goes severely against me because some news happened that sends the market the other way. The likelihood of that happening is very small. The risk of ruin to me and my account, if that did happen, even though unlikely, is extremely high. I could potentially blow an account if I do not have a physical stop in place and something goes very, very wrong. The risk of ruin trumps any other whatever I may have about risk appetite. I do not want to put myself in a situation where I am not able to trade tomorrow. Well, tomorrow's Saturday, but you know what I mean. I don't want to put myself in a position where I can't trade the next trading day. So for me and my risk appetite, this is a requirement. I will not enter a position without having a physical stop in place. That's how I go about it. Other people do not have the same risk appetite that I have. They are willing to let uh, uh, price come back at them and flirt with their stop area as long as it doesn't stay below it or above it or down wherever that stop area is. And so they'll use mental stops. Other people cash flow themselves out of it, so they will, try to put a little bit more on near their stop and then get out of it and average their price through better. I can't speak to those. I don't use or leverage those methods. I always, always, always have a physical stop. How do you know where to do it? Well, we talked at the top of the session about automating, where was it? This question by Reversion had to do with how do you deal with market regime changes, and I talked for a bit about this piece here. In my automated systems, all of my risk and target setting are dynamic algorithms based on, but not limited to, a number of different conditions happening. So I don't know what Monday's risk amount will be on my uh, on my personal algos. I don't know what I don't know how much it will be risking. It's also dependent on which equity it's trading. It risks different amounts depending on the price of the equity and the volatility of the equity. So I don't have like a fixed risk amount. It depends on the market environment. It depends on the equity. It depends on the time of day. It depends on all these different factors. So that's how I approach risk. I do have a max risk. I have limits. There are, like, for example, I will not take more than 2 points of risk on my automated system on any of the symbols. And that is a magic number, but it's also tailored to my risk appetite. And it's a self-preservation thing. Like, I don't think that I do well taking 2 points of risk on any of those automated trades because, well, for a multitude of reasons. But I do have a magic number in there as an upper threshold on the largest amount of risk I'm willing to stomach. It's not going to exceed 2 points. So that is one spot I do have a magic number. But in general, I do try to keep my stops dynamic based on market conditions and other algorithms. That's how I get the distance for the stop and footprint volume analysis and volume profile analysis as well in an automated sense. And then I always use physical stops. With the only piece that's not dynamic and that has a magic number is my maximum limit. My max limit for risk to take is not a dynamic feature. It is a hard coded magic number. I am not willing to risk more than that. And I think that's okay. I think having a max drawdown be explicitly defined by a magic number is okay. That doesn't change for me. In terms of motivation for how to handle stops, well, that really depends on the strategy, yeah. Like, what kind of strategy is it? Is it a trend following strategy? Is it a... Oh, damn. Yeah, things are falling apart. Wow. Wow. Um, uh, is it a trend following strategy? Is it a reversion strategy? If you're playing mean reversions and this is the level you're reverting off of, you probably shouldn't be giving super wide stops if you're expecting it to come down into this level and bounce. Um, you know, if you're doing mean reversion and you're only capturing a small amount, it doesn't make sense to have stops down here. And if this is the big level, I mean, so yeah, it is really dependent on your strategy and your approach, I would say. I mean, another question that you could derive from your line of questioning here is, well, let's say it is a mean reversion, and let's say I do want a tighter stop. How do I determine if it should be here, 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 or here, or some other place? That's a completely subjective, like, decision, right? Where do you go? Well, it doesn't have to be. You can derive stop levels from other places. You can look left and see other areas of support and resistance. You can look left and see other areas of heavily done volume. You can look at full day volume profiles and look for big nodes to lean against. You could look at range of the most recent bars over the last X number of bars and say, you know what? The last several bars have only been 10 ticks in range, and so I will have a 10 tick stop. I don't expect it to I don't want it to go to my in reversion level and go a full average bar widths range low, beyond that, that's where my stop will be. So you can dynamic, and if the range contracts and it's only doing 50 or 5 ticks range, that will dynamically change to put a 5 tick range stop in. So I definitely do recommend using the dynamic when you're building automated strategies from that standpoint, because then you are avoiding those magic numbers, because as regimes change, hard coded stops of, let's say, 5 ticks or 10 ticks will not work in certain market environments. You will get thrashed. You will get absolutely thrashed with that. Ask me how I know. I feel like this coding stream is just me like venting my past traumas of getting my ass kicked in the market, um, but hopefully you guys can pick something up and lose less. Can you add to the discussion what you're using for stop and target? Are you using a limit order for target and stop order for the risk? The results will be different when you're using a trailing stop order. Yeah, so Ahmed, this is a good question. My physical stop is always a stop order. I always use an actual physical stop order. For my targets, I actually use, on my automated side, I use market orders for these. I actually use market orders, which may be surprising to anybody who knows how I trade discretionarily, because I typically only use limit orders for entries and exits on my discretionary trading. But on my automated trading, I am using market orders. And the reason why is pretty straightforward. The risk of not getting a fill or a complete fill is greater than the need to get the exact tick and price. And again, this comes back to personal risk appetite. My need on my automated strategies to get a full fill is greater than my need to get a particular price. I need a guaranteed exit. And I'm not saying I want a guaranteed exit. I need a guaranteed exit. If my strategy hit its target and I only got filled on 5 shares out of 1,000, that's a problem. That's a problem. And then it comes back all the way on me. That's a problem. I am willing to take the tick or two of slippage and hit the bid with a market, or hit the, whatever I'm doing with a market order, and get a guaranteed exit. That is the most important part for me. That may not be the most important part for you or whoever is listening. So I think it comes down to your risk appetite, or in my case, also my clients' risk appetites who I'm building these systems for. Some of them don't care. Some of them only want to get out at that price and nothing less than that price. Some of them want to get out with a guaranteed exit. So you really have to ask yourself, are you willing to be in a position where you entered here and then your targets, let's try to draw a straight line. Your target's here and it gets right there to this target, and you waited all day in this trade, and then it only fills you, or you don't even get filled. You're in the queue, but you don't even get filled. You get nothing off there, and then it comes back to stop you out. Are you willing to suffer that? I am not. For me, this is not worth this. The risk of this is not worth it. I have had this happen too many times to me, and this risk is not worth it to me. As soon as it gets in here, and I even have certain versions that have these, like, I don't know how, I'll refer to it as a buffer zone, where if it gets into my buffer zone and then does not hit my actual level and starts to like fade away from that buffer zone, it'll take the market order as well. So I'm hyper about getting mine when I hit my profit targets. Um, Also, it depends on market regime too, how aggressive you want to be with these buffer zones, how wide they are. Um, but that's a whole level of complexity that we don't need to go into today. So I've been going for an hour and a half anyways. Yeah, so if I come up and I tick that price, I am market ordering out of that, and I don't care if I get filled here or here. I would care if I get filled here, but that has yet to happen. I've never gotten a poor fill on a market order out of this, because usually it's still on its way through at the time. I've actually gotten better than expected fills. Doesn't happen super often, but it does happen sometimes where I'll get a tick above where my actual price was, because the momentum and the buyers are still, or whoever is coming, still through that level. But yeah, I am not willing to accept the risk of taking it all the way back or having a partial fill. That skews my performance heavily. So really good question, Ahmed, on that. Um, Gonna mute this guy. Boom. Okay. Trading X asks, when you are on holiday, do you move into big moves like swing trades, or do you just not trade? I have different trading accounts for different concerns. I have, oops, I have my intraday equities discretionary account. I have my intraday equities automated account. I have swing trading accounts, and I have my retirement accounts from when I used to work in the corporate world. These do not talk to each other. They are for different concerns. My retirement trades are more of investments. My swing trades are swing trades. My automated trading does not know about my discretionary trading and vice versa. Everything has its own. There can be times where I'm short something in my intraday account that I'm long in these two accounts. That happens actually quite frequently. It may have even happened today or last week. It happens very frequently, especially on the short side with the intraday stuff. I can be long something for several years, months or years, and be shorting it for, maybe a week straight in my intraday account. That's totally fine. Why? Because they're completely separate. The philosophy of the investment or of the swing is completely separate from the intraday move I'm trying to capture based on the system that I'm employing. Good question. In terms of holiday, yeah, I mean, I don't like during the summer. I trade significant. I try to like this week. I took most of the week off except for today. I put a trade on. I try to trade significantly less the discretionary account during times when the market regime is not aligning with my strategy. I do allow my automated account to continue trading because it has automations in place to deal with market regime changes and even during like market holidays or low volume, low volatility periods, etc. So because it has code to deal with that, I let this continue to trade. These I don't even look at on an intraday basis. I try to log into this account like maybe once a year, twice a year, maybe. I really don't manage my retirement stuff or my long-term swings on a daily basis. I may log into the retirement accounts maybe twice a year, and then the swing trading ones maybe once a month to just see how things are going. But it's a completely separated trade philosophy and system of concerns there. Okay, let's see. Um, Luca's got one more thing, and then I think we'll call it because I still have not eaten breakfast and I'm hungry as hell. Stops, I'm always in the boat of risking less by putting on less size. Currently been working with rotation sizes. Uh-huh. Dynamic. I like it. Doing it by hand now. Um, how much of the rotation is left? Great idea. I love this idea. This is definitely codable. You should work on that. Struggling to figure out how to code the rotations without magic numbers. Yeah, so, um, man, that's a great question for the. I wish this one you had asked at the very beginning. That's a great question. Coding rotation analysis without magic numbers. That is a very good one. One thing you can do is obviously, if you have a rotation based range bar period, then you can't do that. But if you want to use a time-based, if you want to use a time-based x-axis and timeline, then you can see what average rotation durations are, or sorry, what average rotations are for a fixed duration, and then go from there. So if you have, let's say, 5 minute, let's say you have a 5 minute bar chart, and you have rotations that vary in size, you can iterate over X number of bars and then take the true range of each bar and then sum them, average them, and then you have an average range of what a 5-minute bar does, and then you can use that, and that's dynamic. I do use this similar approach for assessing risk, actually. So um, I do something very, very similar to this in my own automated stuff. Okay, we are going on an hour and 36 minutes. I am going to pull the plug here on this and go get some food and get on with my day and get some work done. Good questions. I really like the fact that people came with questions today. That helps out a lot, not have the dead time. Appreciate that, guys. Let's do that again next time. Have at least one question per person so that we can just go boom, 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 because it's more interesting that way, and I think everyone learns. So with that, I will. Oh, what's the other thing? These last couple of weeks in August, I'm gonna be really careful. Um, I'm even contemplating like taking time off to just go, I don't know, camping with my kids or something. Uh, this is going to be really rough trading, I anticipate. Why? Because it has been for the last 20 something years that I've been watching the markets. And this last week of August can just be brutal. Just choppy, choppy, chop, chop. Not saying it's going to be, it's just saying that it typically is. So I'll have to watch out for that and just um, trade lightly, or I might just go away and get work done. And I'm assuming the first week might be quiet as well, and hopefully by the second week of September things pick up as everyone gets back into the office and things start moving and shaking again. All right, yes, I'm gonna go eat breakfast. Uh, have a wonderful weekend, guys, and catch you on the next one. And